Welcome to Chapter 12 in Personal Finance. In this chapter, we are going to start talking about investing in stocks, which so many students tend to enjoy because we know that the stock market can potentially make us wealthy. So, in this chapter, you're going to learn all about what the stock market is, and you're going to learn a lot about how to be successful in buying and selling stock. So let's jump right into just how does stock work? Because, it's kind of hard to wrap our minds around because this is not something that's tangible. This is not something that we can, see and we can touch and feel and understand how it's making money. In fact, we call stocks an intangible asset. So, the idea with stocks is that you would purchase a share of a company because whenever you purchase a share, you're getting a little bit of ownership in that company. So we call that equity. So you purchase a share of a company and you're hoping to sell that same share for a higher price later on. Now, some people are doing that hoping to sell it for more a week later, and others hoping to sell it for more decades later. Now, it is going to be safer when you have an investment and you invest for the long run, not something where you're doing day trading or you're just frequently making these trades, because typically that is not going to end up ultimately making you money. Instead, people end up losing money when they're doing that for the most part. So the biggest thing here is we are looking for something we call stock appreciation, where we sell the stock for more than what we paid for it. Another thing we're looking for is dividends, and we're going to talk about both of these more in just a minute. But what are you getting when you get a share of stock? As I said, it's equity. It's a little bit of ownership in whatever company you're purchasing. So if it's Amazon that you buy a share of stock of, then you are just getting one little bit of ownership in Amazon. And with that, you are hoping to make a higher return. So you may be along with hundreds or thousands or even millions of other investors. It's not that they're going to be calling you, hey, what can you do for our company? You just have a little bit of ownership in that company. So, as I said, stocks are an intangible asset. Can't see it, can't touch it. But let's compare it to something physical, something that's tangible when it comes to making money, because I think sometimes that helps us to understand what this is. So, let's say you bought a game system. So you purchase this game system, let's say for $400, and you're like, I already have this at home. I already play this game all the time, but I know that $400 is a really good price. So you purchase that game system and you're hoping within the next few weeks or months that you'll be able to sell that game system for, I don't know, $450, and then you'll make 50 bucks. So that's the same idea with a share of stock. You're hoping to purchase it while it's basically at a discount and then be able to sell it for more. Now, that's not always the case. If it was a game system, let's say you bought it for $400 thinking this is a fantastic deal, I can't pass this up. And then we find out that the next version of that game system is coming out. Well, if that's the case, it's likely that now the price of your game system will drop significantly and it's actually not going to be valued as much. So then you have to decide, do I go ahead and try to get rid of it now with the price dropping, or do I hold on to it and hope that something changes? So very similar idea with stock. You're purchasing something with the idea of selling it for more later. So buying stocks seems risky. Is it worth the investment? Well, let me just tell you, the stock market as a whole has returned an average of almost 10% each year for more than 100 years. So that would lead me to believe that even though it's risky, there's definitely value in this. Now, again, this is the stock market as a whole. It's not that every single company has gone up by almost 10%. We also have to remember it is an average. So some years are up, some years are down, but it averages out at almost a 10% return each year. But in order to get that, you would have to be in it for the long run, not just for a few months or for this year or that year. If you put your money into the stock market and you actually need it soon after, then you may end up, purchasing it at the wrong time, and then you'd have to sell it when it was in a downturn. So that's definitely not what you want the situation to be. But if you can put it in there and leave it for 5, 10, 20, 30, 40 years, imagine how much it could grow when we're talking about 10% a year. Those are crazy returns compared to just basic savings accounts. So let's talk about what the risks of purchasing stock really is. So your risk, for one, is that your potential return on investment should be directly related to the risk that you assume. So what I'm talking about here is that if you were to purchase a share of stock of a company that it is very up and down, you just don't know what to expect from one week to the next, then you're doing that with high risk because you're expecting to hopefully get a high return. Now, if you invest in a company like, let's say, Walmart, then you're investing knowing it is a more stable company and you're not expecting to get some huge return like, wow, Walmart's prices doubled overnight for their stocks. I just can't even believe how much money I made. No, we're not expecting that. But we also know that there's not as much risk with Walmart. So that would be a big reason for purchasing Walmart stock versus a riskier stock like Nvidia. So the long-term investment, as I've already mentioned, will minimize risk because then you can withstand those downturns and then you can really take advantage of the times that the stock is increasing. Dividends are when a company says, hey, we made money, we made some profits, and we want to share that with our investors. So companies are not required to do this, but when they do, we typically see it with more stable companies that are very slow growing, like Walmart. A company that is trying to scale their business really quickly, they're really trying to grow and you're investing in it because you're hoping the stock price just increases really quickly and you make a quick return. Those are not the companies that typically pay dividends, and that's because they're taking their profits and reinvesting them into the company in order to make you and them more money. So dividends are another reason that investors choose to put their money in the stock market. So we want an increase in the value of the stock and hopefully get some dividends in the meantime. So why do corporations issue stock? Well, this is a form of equity. As I mentioned before, that's where we are going to be giving the investors a little piece of the company. And they do that instead of, like we see with bonds, having debt to the investors. So they don't actually owe them anything. They have a little bit of ownership and they have some rights to vote, but they don't actually owe them anything in the same way that you would with bonds. And also, dividends are not mandatory. With bonds, interest is mandatory. Anytime a company borrows money, they have to pay that loan back and they have to pay interest. Well, when a corporation issues stock, they can get money from investors, but they don't owe them anything. They may choose to pay dividends, and a lot of companies do, but they don't have to do it in the same way that interest has to be paid. So that's another big advantage. So then the investors, they're looking for those dividends. They want to get that return as they hold the stock in a lot of cases. A lot of times when I invest, I'm not really looking for dividend paying stocks because I am sometimes putting my money into companies that I really am expecting to grow, not as much just slow and stable and just slowly increasing while paying dividends. So you have to choose what you want there. Or of course you could have a mix of the two. And then that dollar appreciation, where the value of the stock increases. Now, value increasing could mean a lot of things. This is just where the investors are, whatever they're willing to pay is what the value of that stock is at the time. So we may have an outlook on the company that we say, wow, it looks like they're going to continue to do better and better and better. And so investors are willing to put more and more into the company. If something negative happens that impacts the company, then we're going to see their stock prices drop. So it's really just whatever investors are willing to pay. And so we're hoping that we will purchase it at a low amount, sell it at a higher amount, and we'll see that dollar appreciation. And that's where our big returns can come from. So here's an example that we're going to walk through that talks about purchasing 100 shares of stock. So they're purchasing it on July 31st, 2018, then they sell it just 2 years later, July 31st, 2020. The dividends are $1.73 per share for the whole 2-year investment period. Now make sure you pay close attention when you do your homework, because sometimes it might say they paid a total of $250 in dividends, and that covers all the shares. Or it might say $1.73 per year that they held it, and you'd say, oh, well, that's going to happen 2 times during these 2 years. But in this case, it says the dividends were $1.73 per share for the whole 2-year investment period. So let's see how much of a total return this investor made. So if you look here on the left, it says cost when purchased. They bought 100 shares at $67 each, so that's $6,700 that they put into the company, into purchasing these shares. They also had to pay commission. Now, this is not unusual at all to have to pay commission whenever you purchase shares of stock. So they had to also, on top of that investment to purchase the shares, they had to pay another $25. So now they're all in for $6,725. Then 2 years later, they sold it for $98 a share. That is a really good return there. So they're selling it for $98 a share, so they make $9,800. But there's commission on that end as well. So instead of getting the whole $9,800, you're going to subtract out the commission, and the investor gets what's left over, which is $9,775. So the difference between what they sold it for minus what they bought it for, and keeping commission into account here, the difference is $3,050. Then we have to think about those dividends. They had 100 shares. They got $1.73 per share. So we have a total of $173 in commission during the 2 years. So we're going to add that to that dollar appreciation amount, and total return for this transaction is $3,221. So I think they did a pretty good job. They made about half of their money back, or made like another 50% on their money. So making 50% in a 2-year investment is a good return in my book. So just some examples that I've seen that made me either want to purchase stock or stay away from stock. Here's some headlines that I read, and this might trigger your thoughts on a company. So Delta ditches Lyft for an Uber Perks partnership as loyalty programs land big profits. Okay, so when I read this, I was like, Delta is making a partnership with Uber. So I might want to buy some Uber. So what I did was I went on to the account that I purchased stock, and I saw that Uber they had not seen a massive increase after this announcement. So I went ahead and purchased some Uber, and it did go up a good bit over the next several weeks. So that ended up being a good purchase. Quantum stocks plunge after NVIDIA's CEO says the tech is decades from being useful. My husband had been talking about quantum stocks and quantum computing, and whenever I heard this, I was like, you know what? I'm going to purchase shares of different companies' quantum stock, and hopefully it's going to go back up. And I actually bought that for his birthday, and it did go back up. This was extremely up and down, which we're going to talk about what that's called in a minute. But this quantum computing was very much up and down, up and down. So I sold it just a couple months later. Barnes & Noble's plans to open 60 stores this year as part of the neighborhood bookshop strategy. That made me trigger, okay, you know what? If their stock hasn't gone up too much already, then I'm going to go ahead and purchase some, because I think that's going to cause their stock to increase. And that did as well. So these are some of the triggering events that made me want to purchase stock. But we have to remember that even with these things, trying to time the market and buy and sell in a short period of time is very risky. So if you're going to do this needs to kind of be some play money that you've been saving on the side for something like this. This is not your rent money. This is not going to be money that you would lose and you would be in big trouble, because this is not diversifying our money as much as we would want to, and the way that we could see that in mutual funds that we'll be talking about in the next chapter. The bull market and the bear market. Have you ever heard of these? So the bull market is just a time period where stock prices as a whole are really increasing. Prices are rising. So they're like, wow, things are really looking up. The economy outlook is really good right now. So we're in a bull market. A bear market is when the prices overall are dropping. It's kind of like inflation, deflation that would cause prices to go up and down. It's kind of an economic outlook. And we just want to make sure that we're not selling our stock in a bear market when it's low and buying it when everybody's excited, because think about it. If you bought that game system that I mentioned earlier when it was at its highest and then try to sell it when it was at its lowest, like, you lost the whole purpose of that investment. Instead, you just lost money. And I know that's not what we want. Stock splits are really interesting, and this slide is one of my favorite slides. I love this. So stock splits are where a company is going to take each share, if it's a 2-for-1 split, and they're going to split it into two. Now, if you already own stock, if you own one share of stock and they split it into two, now you have two shares, but the value of each share is half. So nothing has actually changed for you. If it's a 3-for-1 split, you had one share, now you have three, but they're each worth a third. So the whole purpose of a stock split for a company is just to allow their stock prices to decrease and let the entry amount to be lower. So if it has gone up to $1,000 a share, that's going to deter a lot of investors from putting their money in the company, because that's a big chunk of money to put in. So if they do a split and they decrease the price per share, it can help to get more initial investors. So it doesn't really change anything for the company. It doesn't really change anything for pre-existing investors. It just makes a difference going forward for future investors. We also have preferred stock. So preferred stock is not offered by every company, but if it is, then if there's any dividends paid, a lot of times they're going to get priority over the common shareholders, and they would know how much they will get if dividends are paid. They also would have the first claim to the company's assets if the corporation were to liquidate. So that's some of the perks of being a preferred stockholder. So when it comes to evaluating whether or not you want to purchase a company's shares of stock, you want to first do research on that specific corporation. Then you want to make sure you're doing research on the industry as a whole and on the economy. And when I say industry, I mean like automotive industry or the retail industry or the pharmaceutical industry. Then we want to see the whole economy. How is it doing? And that will help us decide whether or not this seems like a good time to invest in general, good time to invest in the industry, and is it a good time to invest in that specific corporation? So do your research. There's lots of articles out there all the time, all kinds of current events that can help you to understand, is this company doing well? Is there a positive forecast for this company? Or are we seeing things decline and, maybe this is not a good time to get in? We also want to consider our risk. Everybody's going to have different risk levels that they're willing to take and different amounts of time that they have before they need that money. The more time you have, the more risk that you should be willing to take. The types of risk, we've got systematic and unsystematic risk. So systematic occurs because the overall risk in the market and economy. So there's always going to be a risk that stocks are going to be going up and down. We cannot eliminate this, even through diversifying and putting some into this industry and some in that and some in that one. We still can't eliminate it because the market as a whole is unpredictable. Unsystematic is where we are putting our money into maybe one specific company or one specific industry, and then it does poorly. That was a risk that we could have avoided to an extent with diversification. So systematic, we can't avoid. Unsystematic, we can. So the big thing here is diversification. Don't put all your eggs in one basket. Don't put all of your money into one company unless you're willing to take on that risk. Some very risky investors would say, no, we need to put all our money in one company because that way, if it does well, we're going to get tons of money from that. But of course, if it doesn't do well, then you could lose all of your money or a big portion of your money because you had it all in one company. Now, diversifying can reduce how much of a return you're going to make because you have it in different industries and different companies, but it can help if this company loses money, this one over here might make enough to make up for it. So, diversification is a good way to lessen your risk. Now let's look at some of the factors that investors consider before they put their money into a company's stock. One of the main things is EPS, which is earnings per share. This helps us to see with the money that is put into the company, how much are they earning? So we take the earnings from the company divided by the number of shares outstanding. And outstanding here just means the shares that are in the investor's hands. So if you see this increasing over time, then that is a good sign. We want the earnings per share to be going up, and it shows that the company is making good decisions with the money that's being put into it, and they're making a higher return from that. So next we're going to look at the price earnings ratio, or the PE ratio, and this is another big thing that investors consider. Now you have to already have the earnings per share calculated in order to calculate the price earnings ratio, and that just takes the current price per share divided by the earnings per share, and that just helps us to see how much they're earning compared to the price that we're paying for that stock. Then we have the dividend yield. If it is a company that's paying dividends, we could think of it kind of like getting interest as a return while we're holding that investment. Now, we wouldn't expect this to be a really high interest rate, but this is going to kind of compare it as if it were. So the word yield simply means a return, or it's like having interest come in. So this would be like the dividend return. So we take the annual dividend amount, the dollar amount of dividends that you receive for the year, divided by the current price per share. And that's going to give you a percentage, or you're going to turn it into a percentage, and that will help you to see the higher the percentage, the higher the return you're getting for dividends. So we want this number to be increasing over time, or if we are really looking for stocks that we're going to hold for a long time, we want them to stay stable but pay dividends, then the higher the dividend, the better. And you can look at historically how much do they pay in dividends. The total return we've actually already calculated. When we looked at that example where we bought the 100 shares of stock and held on to it for 2 years, that's really what we did here. We calculated what the dividends were. Remember, it was $1.73 per share. And we calculated the capital gain. How much did we sell it for compared to how much we bought it for? Any difference hopefully was a gain and not a loss. But those two added together are just the total return. But just remember, you have to take commission into consideration if that is also included in the problem. Now, a beta, while this is a beta fish, and that's what I had when I was in middle school, that's not what we're talking about when we're talking about the stock market. A beta has to do with how risky a company's stock is, and that just compares it to the other stocks on the stock market as a whole. So the beta for the market is 1. And you can go on to a site like yahoo.finance.com, and actually, I think it's finance.yahoo.com. You can go to that site, and if you look up any public company, it will tell you what their beta is. If it's below 1, it means that it's very unrisky. It's not unpredictable. It's a more predictable company like Walmart, as I mentioned before. They have a low beta. If the beta is above 1, it means it's riskier than the market as a whole. So that will help you to consider, if you don't really know a lot about the company, how risky it is. That leads us to volatility. So the beta has to do with the unpredictability, which we call volatility, or how volatile a certain stock is. So that just means the unpredictability, the ups and downs of a certain stock or the market as a whole. So some companies are way more volatile than others because some have been around for a long time. And again, they're not trying to expand quickly. They're just got slow and steady increase. Where other companies, they are just constantly trying to put everything into new ideas and scaling their business. And sometimes that causes their stock to go up and down for every little thing that happens. So that would be a very volatile stock. So if you want to calculate the volatility for a stock, you take the increase in the overall market, and you'll be given that number times the beta for that specific stock. And that will help you to see how volatile that particular stock is compared to the market. It's not a bad thing to have a stock that's volatile. It's just you have to know you're going in for the, what kind of risk you're taking on when you purchase that share. The book value for a share of stock is just their assets minus their liabilities divided by the number of shares outstanding, which, remember, outstanding means the shares that are actually in investors' hands, not tangibly, but, metaphorically speaking. So you've probably heard of a stock market bubble, but what does that even mean? So this is a term for when stocks are trading at more than their actual worth. People are getting excited. This is a bull market. Prices are really going up. We've got positive economic outlook. But the market depends on how much an investor is willing to pay for it, as we talked about already. So the bubble that we're talking about here, where stocks are trading for more than they're really worth, can easily burst due to many different factors. It could be unemployment, higher interest rates, the company's forecast lowering. We start to have a negative economic outlook. That can cause the bubble to burst, and that is not a good thing if you've got a ton of money in the stock market and then it drops suddenly. So in those cases, though, try not to sell, because you want to be able to hold on to those stocks and sell them when they've increased again. You want to be able to buy stock when everyone else is selling it and it's low, and sell your stock when everyone else is buying it and the numbers are really high. A few different ways that you can purchase stock. We don't have too much more in this chapter. We've got a market order. This is just a request to buy or sell stock at the best available price. So when you go on to purchase stock on any website, then you're going to be buying it at the market order if you're just buying it at that time. Now there's a limit order. This is the request to buy or sell stock at a specified price. So you set this up and then you purchase this, and ensures that you will buy it at the limit when the price hits that limit or it goes lower. So you're like, I really think the stock is going to drop today and I'm going to be at work and I'm going to be busy. So I'm going to set this to where it will purchase the stock if it drops to this number or lower. Or you can sell the stock if you set it to sell at a certain high price. If it goes that price or higher, I want you to sell it right away. And you can set that up to work for you in the background while you're doing whatever you have to do. Then we have a stop loss order. This is where you sell a particular stock at the next available opportunity after its market price reached a specified amount. So we want to go ahead and prevent ourselves from losing any more money. So go ahead and sell it before it gets any lower. There are many different techniques when it comes to buying and selling stocks. I would say the best one is probably buy and hold. So if you've got a long time to hold that stock, you can withstand the ups and downs. So buy it. Don't let every little thing that happens with the market scare you. It's okay. You're in it for the long term. So you can just buy it and watch it grow. And there might be some rough days, but that's okay, because it's for the long run. And that's hard to do. And you might find that, purchasing stocks is not right for you because you aren't able to just buy it and hold it, and you really panic and get stressed if it's going down. So if that's the case, then this might not be the right thing for you. There's day trading, which I would not recommend. This is where you're buying and selling stock on a regular basis, as little as every day, trying to just make a quick penny. And this does not turn out well in the long run. You might have a few wins, but it's very close to gambling, and I do not recommend day trading. Then there's dollar cost averaging. This is kind of saying, either I've got the money, but I'm afraid to put it all in at once because what if it drops even more? Or maybe you don't have it all right now and you just each paycheck want to purchase a little bit more. So in this case, you're maybe buying one company or a few companies' stocks, but you're just buying a little at a time and it averages out. So let's look at a little example of that. In this example, they purchased stock every year for these 7 years and they purchased $2,000. Now, the stock price changed each year, but they put $2,000 in each time. When we divide it by the stock price, it's going to tell us how many shares were purchased. So there might be some years that go up, some years that go down, but it helped to average it out over time so that you're still purchasing it on a regular basis, but you're not putting all of it in up front and then afraid that it's going to drop. So this can lessen some risk, but typically with a good company, prices continue to increase. So if you can put it all in earlier, then that might allow you to get a higher return. But this is definitely something to consider. Buying stock on a margin, this is where you're going to get very risky. You are literally borrowing money to purchase stock. So do not recommend this, but you might say, I've got $5,000 to put into this company, but I think now is a fantastic time to buy. So I'm actually going to go ahead and buy on a margin. And look, this is something that was advertised to me in my account. Said you can borrow $4,985, and then it tells you the interest rates based on how much you're borrowing. So in this case, it's less than 50,000, so I would pay 5.75% interest when it advertised this to me a few months ago. I did not do this, but if I chose to do that, I would not only be paying this interest while I borrowed it, but if the stock were to drop, I'd still have to pay it back and pay the interest, and I would have lost money on the stock decreasing. So this just seems a bit too risky. Another really risky thing, and this is the last thing we're going to look at in this chapter. And this video has been a little long, but this is a lot of information to cover. Selling short. This is a very unique situation where the investor says, I'm actually buying this stock hoping the price decreases. So they borrow the stock from a firm and they say, hey, I'm going to give you this same stock back later on. So let's say it was a month later, I'm going to give you the stock back. So they immediately sell it, hoping that they're selling it for a high price. Then when it comes time to give that stock back, they're hoping to buy it back from other investors at a lower price when it drops. Does this ever work? Absolutely. There are definitely times that this can work, but this is you betting that prices of stock will drop. But this is putting money that you don't have already, that you're borrowing basically, into this investment, and it could end up costing you more money than what you were even going to invest in the first place. So hopefully all of this was helpful to get a good look at what the stock market really is, how you can make money, and ways to make it even riskier. So hopefully you stay away from those super risky ways. But when we get to chapter 13, you're going to see ways that you can be in the stock market without having to choose individual companies on your own so that you're not stressed about making those choices.